Okay.
Right.
So before we get into anything crazy, okay, I want you to just take it a step back real quick and realize that to find the intrinsic value of any asset, okay,
Mm-hmm.
that has cash flow, this is the simple formula. Price equals cash flow divided by risk.
I
That's
see.
it.
Mm-hmm.
That's it. Okay. Now I will give you. Let's go here. I did the little nomenclature. Now intrinsic value. Let me just go and tell you what that means. Okay. We can value anything this way if it has an income stream or a cash flow. Okay. So
Yeah.
what do we use this formula for? Okay. We use this formula to value regular stocks, like Amazon or Walmart that you see every day in the market. Okay.
Mm-hmm.
And a lot of people don't know this. The bond market is twice as big as the stock market. Okay. How do
Yeah.
you guess how we value bonds?
How?
With this formula right here. Okay. We got
Nice.
a coupon rate and we divide it by the risk equals the value of the bond.
Mm-hmm.
Okay. What else do we use this to value? We use this to value real estate.
Mm.
Okay. Net operating income divided by cap rate for all my real estate people out there. Okay. Um, but we for sure use this in business acquisitions. Okay. So I one time I was at a analyst conference, and there's like 100 analysts from around the world, and this they had given us all like the business to value before we got there, and they asked for volunteers who came up and showed their model. And there was this girl from Central America, and you should have seen her spreadsheet. I mean, it was beautiful. Okay, but she came out with like a stock price of $78, and they said, "Does anybody have any comments about this?" And so nobody says anything, and I kind of raised my hand, and I was like, yeah, your stock price is high because your growth rate assumption is too high. The professor guy who was teaching the class absolutely went nuts and started pointing fingers at all these people and saying, did you see that? Did you see that? And they're like, no, no. So I came a little superstar that day, and it was fun for me, but it was just because I didn't forget about this formula.
Mm.
Okay, does that make sense? I'm
Yes.
trying to say is you can get into all the nitty gritty of what everybody's gonna say or super LBO analysis. Just go back to this. Always never forget this equation. Okay, so what we call this is really the Gordon growth model. Okay, so we have the nomenclature here. D1 is cash flow at time one, so it means one cash flow period in the future. Okay. Then we have the R here is acquired rate of return.
Yeah.
We have G, which is the growth rate. Does anybody here on the call think that they cannot do this equation?
That seems simple enough.
I mean, somebody with a middle school education that should be able to do this equation. And literally, this is what the whole finance world is based upon. This simple
Mm.
formula right here.
I see.
Okay.
Yeah.
So let's use an example here. Now, this one is D1,
Mm-hmm.
$1.59. Now, this $1.59 could be $1.59 dividend. This could be $1.59 million. This could be $1.59 billion. It doesn't make a difference. It's just
Right.
there's no difference in the scale. Okay. So what we did is we have a rate of return 10%.
Yeah.
We have a growth rate of 6. We come down here, we do the math, 159.04. We get a price of 39.75. Okay.
Mm. Okay.
Okay. Not too complicated, right?
Yeah.
What gets more complicated we're getting into is how do we pick this top part of the formula, and how do we choose the bottom part of the formula? That's what PhDs and all this stuff that we do comes in, but I want you to see it on a basic level. Okay. So over here is exactly what we calculated, right? So we came down here, we got the 1.59, got the 39.7, right? I want you to look at this other column over here in the multiple. Okay. Here we are. We're using the same exact numbers, 159, R10, G6, right?
Yeah.
We come down here to the $1.59 over 0.04. And guess what? Through the magic of algebra, we can flip this point over 4. So if I take 1 over 0.04, we get a 25. Okay? If I take 159 and times it by 25, I get 39.75.
Yeah.
This is how we get the multiple of earnings.
I see.
Okay?
Yeah.
And so because somehow this formula is so complicated that we had to flip it back over to make it a multiple for people to make errors so that we get that number. Okay. So when you have people, when they're talking in the marketplace and you're going, well, this is 2 times SDE or 4 times EBITDA or whatever, you have to remember to go back that this is the model that we're really talking about, which is really when I go back, cash flow divided by risk.
Yeah.
Okay. So I just want to make sure everybody starts off on their footing that it's not the multiple is really coming from the Gordon growth model. Okay.